Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. This is the first episode of the second season, and we'll be covering slightly more complex topics. To start, I want to talk about beta and capital asset pricing model. These two will round up our understanding of the stock market. If you want the code behind the dashboards or a written version of the material, there's a Patreon link below, but let's get into it. Let's say you buy the S&P 500 through an ETF and someone asks you why. After all, you could have invested in a single business, bonds, crypto, or just stayed in cash. So what's the investment thesis here? At its core, the market is just a collection of businesses. And in general, companies that sell more and generate profits tend to be worth more than those that don't. If you invest in a single company, your outcome depends heavily on its specific risks. If that company sells bikinis and we enter in an ice age, you're in trouble. As you add more companies, those individual risks start to cancel out. Some firms fail, others succeed, and what you're left of is with a bet on businesses as a whole. So buying the market is really a bet that, over time, companies as a group will keep growing and generating profits. We can divide the sources of returns in two categories. First, systematic returns. These are driven by market-wide forces like interest rates, inflation, economic growth, and overall investor sentiment. These forces affect many companies at the same time, which is why stocks often move together. Second, idiosyncratic returns. These are specific to an individual company, things like earnings reports, new products, or management decisions. At any point in time, a stock's movement is a combination of both, what's happening to the market and what's happening to the specific company. As quants, we of course want to quantify this difference. When the market goes up, say 1%, sometimes the stock jumps 2%, and sometimes it barely moves. That's what beta measures. Beta measures how sensitive an asset is to the market. If the market moves, how much does this asset move? A beta of 1 means it moves with the market. A beta of 2 means it moves twice as much. And a beta of 0.5 means it moves half as much. Think of beta as a volume knob on market exposure. It doesn't change the song, just how loud you hear the market. If the market moves 10%, a beta 1 asset moves about 10%, a beta 2 asset moves about 20%, and a beta 0.5 asset moves about 5%. To calculate beta for a specific stock, you need historical prices for both the stock and the market. We'll use SPY as a stand-in for the S&P 500. From there, you calculate daily returns and then use those to compute the covariance of the stock's returns with the market, divided by the variance of the market returns. Let's look at some results. 1 year of data is on the shorter side, but it's enough to illustrate the idea. Nvidia came in around 1.9 and amplified market movements. JP Morgan came in close to 1 and moved roughly in line with the market. Coca-Cola came in much lower, meaning its movements were far less tied to the market over this period. Notice how these three names already feel different as investments. The intuition is exactly what beta is trying to capture. So we can measure how much market risk a stock carries. The natural next question is, given that risk, what return should you expect? Suppose the market returns 10% and the risk-free rate is 2%. The market's excess return is 8%. That's the reward for taking on market risk rather than sitting on cash. Now take a stock with beta of 2. It carries twice the market risk, so it should offer twice the reward. So 2% plus 2 times 8%, that's 18%. And a stock with beta of 0.5, that's 2% plus 0.5 times 8% equals 6%. Different levels of exposure imply different expected returns. That relationship is exactly what the capital asset pricing model formalizes. Each piece maps directly to what we just covered. The risk-free rate is your baseline, the return you get for taking no market risk at all. The market excess return is the reward for stepping into the market. Beta scales that reward according to how much market exposure the asset actually carries. So the formula says your expected return is your baseline plus your market exposure times what the market pays for that exposure. Earlier, we defined alpha simply as the difference between a stock's return and the market's return. That works as a first pass, but it assumes every stock has the same market exposure, which we now know isn't true. A stock with a beta of 2 should return more than the market in a good year. That extra return isn't skill, it's just the price of taking more risk. Before we call anything outperformance, we need to account for that. Take a stock that returned 25% in a year when the market returned 10%, and the risk-free rate was 2%. That looks impressive, but if the stock has a beta of 2, its expected return was already 18%. The actual outperformance, the alpha, is only 7%. Beta explains the systematic part. Alpha is what's left after you've accounted for it. It's the return that can't be explained by market exposure. So to recap, beta measures how much market risk a stock carries, and CAPM returns that into an expected return. Alpha is then what's left over, the part the market can explain. But there's something we've been quietly assuming this whole time, that stocks actually move together in the first place. We said that diversification cancels out idiosyncratic risks, and that systematic forces affect many companies at once. But we never really ask how much they move together or how to measure it. That's where correlation comes in. In the next episode, we'll look at how to quantify the relationship between assets, which will give us a deeper intuition for why diversification works and where it breaks down. If this was useful, the Patreon link is below.